Welcome, everyone. Thank you for joining us today for the DBRS Morningstar Corporate Real Estate Workshop, how DBRS Morningstar calibrates credit risk in the industrial real estate sector. With industrial real estate currently enjoying a renaissance, driven in large part by the rise of e-commerce, accelerated by the coronavirus pandemic, there is a renewed interest in the industrial asset sector. We thought this would be a good opportunity to review how DBRS Morningstar looks at all credit risk pertaining to the industrial real estate sector. My name is Brenda Lum. I'm the head of the global corporate real estate team here at DBRS Morningstar and will be the moderator for today's webinar. The corporate real estate team members presenting today are Tsichlas and Anthony Bogdan. Note that if you have a question during the presentation, I would ask that you please submit your question using the Q&A box at the bottom center right of the screen, and it will be addressed following the conclusion of the prepared remarks. With that, I'll ask Chris and Anthony to provide a brief introduction prior to the proceedings of the presentation. Chris?
Great, thanks, Brenda. Good morning, everyone. My name's Tsichlas. I'm a vice president in our real estate corporate ratings group at DBRS Morningstar. Lead analyst on a number of our real estate issuers. Been with the firm for about 4 years now, and I've got a background in M&A and real estate advisory, and I'm a CFA charter holder. Thanks. Over to you, Anthony.
Thanks, Chris. Hi, everyone. My name is Anthony Bogdan, and after earning my CPA in December 2020, I joined DBRS Morningstar as a senior analyst in the real estate credit rating group. Thanks for coming.
So I guess just moving on to our agenda. So now that we've got introductions out of the way, Anthony will provide a brief recap of what we've seen in industrial real estate over the last few years, some of the secular trends that are benefiting the sector. Then Anthony will provide a brief review of our methodology, rating entities in the real estate industry. And then following that, I'll get into sort of marrying the two to sort of look at how we apply the methodology and how we view sort of those recent trends in industrial real estate through the lens of our methodology. We'll have we'll highlight a few things in our corporate risk assessment scorecard, and then we'll open it up to Q&A. Great, over to you, Anthony.
Thanks. So, next slide. So while the trends of consumers have been shifting to online purchasing has clearly been accelerated by COVID-19, it was experiencing momentum in years prior, with e-commerce sales compared to total retail sales growing since 2017, before the considerable rise in Q2 2020, the start of the COVID-19 lockdowns. As more consumers shop online, retailers must shift their focus to product warehousing, the need for just-in-time inventory, and onshoring activity, which increases demand for industrial services. One thing to note is that more consumers are shopping for online grocery delivery services, which is indeed favorable for competing space such as cold storage. Next slide. Looking back to 2017 again, the increase in demand for industrial space has outpaced supply, as supply oftentimes lags demand in commercial real estate due to planning, construction, and entitlements taking years to complete. As shown by the graph in the slide deck, absorption of industrial real estate is extremely high, mirroring new supply coming online. With availability rates at all-time lows, it's very clear that the lack of supply is a constraining factor in industrial tenant absorption. This has led to fierce competition amongst tenants who must compete for prime industrial space while supply lags behind for a few years. Next slide. As shown by the blue upward curving line in the graph, asking rents have been continually rising since 2017. Meanwhile, the availability rate has been inversely declining, down to nearly 1% of total space in Q2 2021. That's very little supply. Tenants are willing to pay higher rents to secure prime industrial space because of how limited it is. This is very positive for industrial landlords because they have more leverage in negotiations and are able to rent to higher quality tenants for longer lease terms, which indicates improving cash flow stability in the asset class. Next slide. What this has meant for our industrial issuers is that cap rates have continued to fall, as demand for industrial assets continues to rise. Particularly, positive trends in the industrial asset class has allowed for capital recycling initiatives, assisting issuers in selling older, heavy manufacturing assets and purchasing and developing modern light industrial assets, which are typical targets for e-commerce tenants. Capital recycling initiatives have allowed DBRS Morningstar issuers to further benefit from changing trends in consumer spending. Next slide. Next, I'll give a brief overview of our rating methodology before Chris goes into its application. Next slide. Illustrated is the process for which we rate our real estate issuers. First off, a core assessment is completed by concluding on an issuer's business risk and their financial risk. When a core assessment is reached, we further look to assess if an entity deserves changes to their core assessment through specific overlay factors which may directly move their rating up or down. Next slide. Listed below in order of importance are DBRS Morningstar criteria for business risk assessment. The most important factor, asset quality, is the idea that higher quality assets increase credit quality, often seen through stability of cash flows during an economic downturn, occupancy rates, and cap rates. Market position relates to an entity's importance in the markets that they operate. If the issuer has a history of transacting and is a large player in key industrial markets, they are deemed to have more market presence and negotiating power, which is beneficial to their credit quality. Third, the more diversified an issuer, the less likely they are to default if one portion of their business is negatively impacted, which improves their overall credit quality. Lease maturity and tenant quality is important as long-term leases to high-quality tenants indicate cash flow stability, which is positive for an issuer's credit. Finally, portfolio size. The larger the REIT, the more benefit they receive from the size of their portfolio. Next slide. Financial strength is very, very important to an investment-grade credit. DBRS Morningstar looks to debt to EBITDA and EBITDA interest coverage on a pro forma basis to assess the credit quality of an issuer. Simply put, the stronger the financial risk metrics of a given entity, the higher the credit quality, all else equal. Next slide. And after we conclude on the financial risk of an entity, our core assessment is complete. However, there are certain overlays from which DBRS Morningstar issuers can benefit after a core assessment is made, which may directly increase or decrease their rating. One of which is capital structure. If an issuer's debt stack is primarily unsecured and the underlying assets can be securitized, DBRS Morningstar often applies rating uplift to that issuer. One of our industrial issuers, Granite REIT, currently benefits from a one-notch uplift from low proportion of secured debt to total debt. Now Chris will speak on the application of our methodology.
Great, thanks for that, Anthony. That was very informative. So I think following those, reviewing sort of recent industrial sector trends and sort of our methodology for assessing credit risk of real estate issuers, I think what we're hoping to do here today is to demonstrate how, I guess through the lens of our methodology, these recent trends we've seen in industrial real estate are working to improve credit quality. So I guess the first factor we'll discuss is asset quality, our most important business risk assessment factor, or BRA, as Anthony alluded. So I guess what we've seen amongst our issuers over the last few years is that they're gravitating and sort of high grading their portfolios into sort of more institutional quality assets that are sort of appeal to a broader base of end users, as opposed to sort of in the past, we saw a lot more special purpose, heavy manufacturing type assets, which aren't as certainly, I mean, by definition, special purpose, they're less broadly applicable. And we've also seen high and stable occupancy rates driven by, for the most part, by the rise in increasing penetration of e-commerce, market rents that are well above in-place rents, which provides a certain margin of safety from downside risk of falling market rents. I think historically, where perhaps in industrial real estate for the longest time, rents of $5 per square foot were quoted. Now we're seeing over the last few years, we've seen rents move well beyond $5 per square foot. In some cases in the GTA, we're looking at rents of over $10 per square foot for certain sort of newer, modern spec, high quality e-commerce related assets. One thing that's been quite topical through the recent pandemic was, at least in real estate, was rent collections. It's something that senior management teams did not pay a lot of attention to pre-COVID. Certainly it's been elevated in importance. And one thing we noticed amongst our industrial issuers is, while in the early days, they may have taken some reserves for lower than normal rent collections. I think the way we've seen it play out is that they have not been materially impacted. Their rent collections are virtually 100%, and even rents that were deferred or abated in the past have virtually or nearly been collected fully. One other factor that supports sort of cash flow stability in the industrial sector, which hasn't necessarily changed over time, although I guess it's more applicable with sort of these modern sort of distribution type assets as opposed to special purpose heavy manufacturing assets, is a low cost structure with triple net leases, where landlords are often responsible for, say, new roofs or parking, but otherwise the tenant is largely responsible for all of the ongoing maintenance costs, property taxes, insurance, etc. And so that results in higher margins for the landlord. And then lastly, I guess one other thing that sort of supports our view in terms of improving asset quality in industrial real estate sectors, our expectation for continued growth in online purchasing. Maybe perhaps not at the same growth as sort of what we've seen during the pandemic, but nonetheless, I think we expect e-commerce penetration to continue. We'll move on to market position. So I think what we've seen in industrial, the benefits to asset quality have been quite clear. Market position perhaps hasn't been as clear, but I think we do see benefits here as well, given the ability of industrial issuers to leverage well-located assets in key distribution hubs such as the GTA to enhance their bargaining power, earn higher rents, which, given the triple net lease structure, sort of accrues to the bottom line, and negotiate longer lease terms with their tenants and attract larger, sort of more appealing, lower counterparty risk tenants. Furthermore, one other consideration in market position is the ability to demonstrate a track record of sourcing and executing transactions. And we've certainly seen that amongst our pure play industrial issuers over the last couple of years. In terms of diversification, so we look at diversification across four ways: geography, subsector, property, tenant. Similarly, I think in the case of diversification with respect to our industrial issuers, it really depends on their sort of unique business strategy. But one would expect with sort of increasing size and scale, there should be lower property and tenant concentration, as well as improving geographic diversification. All three of those are considerations in our diversification BRA, particularly as our issuers look to enter new markets, new geographies, as they look to continue their growth in the asset class. Lease maturity profile and tenant quality is another area where we've seen significant improvement in recent years, most notably with longer lease terms, given the improved bargaining power of landlords and some of the, I guess, the larger tenants and the newer assets more appealing, and landlords more willing to enter into those longer lease terms. As well, similarly, in the same vein, we've seen improving tenant quality with larger occupiers, therefore lower counterparty risk. So lease maturity profile and tenant quality is another area where we're seeing material improvement across our pure play industrial issuers. Lastly, portfolio size, our least important BRA, certainly has improved as industrial issuers grow rapidly or relatively rapidly compared to historic norms, while capital markets are accessible. In terms of our financial risk metrics, firstly, total debt to EBITDA. As I alluded in our portfolio size BRA, we've seen issuers look to grow while capital is available. However, as the asset quality in the industrial real estate class continues to improve, what we've seen is in order to compete and acquire these desirable assets in these market dynamics, cap rates are being driven lower. So the assets are yielding lower cash flows, which can pressure the debt to EBITDA metric, dependent on the unique capital plans and funding strategies of each issuer. To the extent that an issuer funds a portion of their growth capex with equity, that can offset some of the pressure on debt to EBITDA. And I'll just add that one consideration in our asset quality assessment, we understand that to the extent an issuer is acquiring higher quality assets, we would expect to see lower cap rates, and that can also act as somewhat of an offset to pressure on the debt to EBITDA metric. In terms of EBITDA interest coverage, so certainly our issuers, we're seeing them benefit from cheap funding in the current low interest rate environment, which is helping to support that our key FRA EBITDA interest coverage. And furthermore, we're seeing issuers take advantage of perhaps arbitrage opportunities as they look to continue to grow and enter new geographies, new markets, for example, Europe, where perhaps they're able to acquire portfolios of industrial assets and fund those with lower cost debt in Europe. That's also helping to support EBITDA interest coverage ratios. In terms of overlays, Anthony touched on this briefly. The most applicable one we're seeing in industrial real estate is capital structure. Issuers are benefiting, in our mind, from a transition to an unsecured debt stack, which, as I say, we think can be credit positive. As a further consideration in that regard, we look for institutional quality assets with investment grade credit metrics and robust coverage of unsecured debt with quality unencumbered assets. Those are sort of all secondary considerations when rating committee is deciding whether or not uplift to their rating is warranted for a low proportion of secured debt to total debt as issuers transition to unsecured debt. So moving on to the corporate risk assessment scorecard. Jen, if you could just flip to the next slide, please. So periodically we publish a corporate risk assessment scorecard, where we disclose our factor scores across our coverage universe for public ratings. And so here we've excerpted our pure play industrial issuers, Dream Industrial, Granite REIT, Summit Industrial, as well as sort of more esoteric cold storage, leading cold storage or temperature controlled warehouse operator, Americold. And a couple things I'll point out here. I guess our pure play industrial issuers, you'll notice the BRAs and FRAs are rated fairly similarly, although they each have kind of their unique nuances depending on their strategies. Asset quality for Americold, we view that as slightly lower than some of the industrial pure play issuers that have transitioned and sort of more of those broadly applicable or in-demand assets, sort of in the kind of the more urban distribution hubs. Americold's, on one hand, they have sort of mission critical facilities in the food supply chain, which can be beneficial. However, they are sort of more special purpose in nature. There is sort of a larger service component, and they have assets that are perhaps in some more rural locations closer to food suppliers, which we would expect to increase cash flow volatility relative to some of our more traditional and commercial real estate issuers, such as Dream, Granite, Summit, where those cash flows are supported by long-term leases. That's one other thing about Americold. A lot of their contracts are on demand, although they are trying to transition to more of a fixed commitment storage contracts. I don't think there's anything else we'd like to point out there at this time. Perhaps we can move on. Thanks, Jen. In terms of closing remarks for our prepared presentation, we see several favorable fundamental factors that are expected to continue to underpin cash flow stability and are therefore positive considerations in assessing credit quality of issuers with meaningful exposure to industrial real estate, which I hope you'll agree. We've kind of provided some support to these points in our presentation so far. But number one, we've seen high and stable occupancy rates. Number two, market rents that continue to be well above in-place rents. Number three, improving tenant quality with larger occupiers. Number four, longer lease terms with improved bargaining power of landlords. Number five, high transaction volumes and increasing valuations, further indicating robust demand fundamentals and demonstrating liquidity in the sector. And number six, an expectation for continued growth in online purchasing. Thank you.
Thanks, Chris, for the prepared remarks, and Anthony. Just as a reminder, if you have a question, please submit using the Q&A button on the bottom center right of your screen. We have a number of questions in the queue already, so I think I'll just pass the first one over to, I'll pass it over to Chris. So in terms of environmental issues, ESG is really important. There's a lot of discussion around it. From an environmental issue perspective, how does that factor into the real estate methodology?
Great, thanks, Brenda. Great question. So I think we view ESG issues sort of more broadly throughout our methodology, including environmental. A couple of examples that I would give is in terms of asset quality. We might look to LEED certifications on an issuer's assets that could make their portfolio more desirable to a broader range of end users and make it easier for releasing and so on. In terms of market position, we might expect that as ESG issues gain prominence, our market leading issuers will continue to demonstrate their leadership through publishing corporate sustainability reports, GRESB scores, perhaps to look to access green bond markets. So those are a number of areas where we see, sort of broadly speaking, ESG fitting within our methodology. I will note, however, that perhaps for industrial issuers, it's a little more tricky because of the triple net lease structure of their leases. They don't necessarily control what happens within the building, although we do understand there are certain things they can do to incent their tenants to try to adopt sort of more environmentally friendly operations, for example, installing LEED lighting throughout the building.
Great, thanks. And we have quite a number of questions here, so I'll flip the second one. I think it's a bit of a jump ball, so Anthony and Chris, if you both want to chime in on this one. How does the real estate methodology account for the differences in the type of industrial assets, such as distribution, logistics, warehousing, light manufacturing, as well as non-traditional forms of industrial, such as cold storage or data centers?
Maybe I'll start out with that one, and then Anthony, feel free to chime in. I think it's very multifaceted. we have to look through each of our sort of key factors that we consider in our methodology, and do a bit of a deep dive. And I think we've touched on a few aspects. So for example, I guess one thing we like about sort of modern distribution, e-commerce related assets close to major distribution hubs is that they are in demand and sort of they appeal to a broad range of end users, and they're easily refitted for a different tenant if an existing tenant vacates, or perhaps repurposed to other uses if needed. In contrast to perhaps more special purpose type properties, which it can be very costly to find and fit out a special purpose heavy manufacturing facility for a new tenant, or if at all. I mean, for example, some rural, sometimes you'll see special purpose assets located in very in markets that have are a lot less desirable than say major distribution hubs. So I think we have to look through all of our factors and consider various aspects, and some of the things we'll look to are occupancy rates, how stable are they, rents, which will sort of contribute to same property NOI growth, net operating income growth, cap rates. When we talk about these sort of more in-demand type assets with sort of e-commerce appeal, cap rates are just continue to trend lower. They're almost on par with other asset classes that we've, such as like sort of traditional retail and office, as where sort of the special purpose type assets, cap rates remain significantly higher, sort of reflecting the risk associated with those assets and those leases. Anthony, did you have anything you wanted to add? Or?
Yeah, just to add on, I think a lot can be seen through the cap rates, occupancy, and the desirability of the building, which you touched on pretty well.
Super. We have quite a few questions here, so I may have to combine a couple of these to try to have multi-part answers here. In terms of secured debt versus unsecured debt, we have a number of questions there. First one, how about just discussing the difference between secured versus unsecured bank credit facilities? If they're relatively under or unutilized, would converting to an unsecured facility be viewed more positively from a credit perspective?
Sure, thanks, Brenna. Good question. So I would say yes. I think we do view favorably an unsecured debt stack versus a secured debt stack, because our methodology, we're really rating the senior unsecured debt at the issuer level. So to the extent that there's no prior ranking secured debt, all of those assets that are unencumbered become available to satisfy unsecured debt holders. So I think, I guess I would say there's a pretty clear benefit that we see for an issuer moving to unsecured debt relative to secured debt.
Anything you want to add in there, Anthony?
Nothing in particular for that.
Okay, and then in terms of maybe part B of this question, when looking at unsecured debt relative to your unsecured assets, do you take into consideration the how much of these unsecured credit facilities do you incorporate?
Yeah, typically we would assume that the credit facilities are fully drawn in assessing our coverage of the unencumbered assets over the unsecured debt.
And part C of this question, in terms of the secured debt stack, notwithstanding that you are rating the unsecured debt, do you make a distinction between full recourse and non-recourse secured debt?
I would say we do view non-recourse secured debt as adding an additional layer of financial flexibility for an issuer. I think that's all I would say there.
Maybe I would add in, having said that though, that that really comes into play if the payments are not made on that secured debt. So we're really looking at these, particularly for investment grade rated credits, to be continuing to pay. And so it's not too much of an issue at this level of rating. We still have a couple of more questions, but I know that one of the thoughts that has been coming up, and Anthony mentioned that in part of his presentation, was what's your view on onshoring manufacturing? Specifically, it's become more of a hot topic with COVID and the inability to source PPE. And how do you see that impacting industrial demand? Anthony?
Well, I think that the longer the COVID-19 pandemic goes on, the more impact onshoring is going to have in the industrial space, because it is getting more difficult with supply chain issues to get product over into Canada. So onshoring is becoming more prevalent, and we see that trend going to continue so long as the COVID-19 pandemic is an issue.
Yeah, I do too. Maybe just we have a couple of minutes left. There's one question regarding the methodology. Do we already factor in ESG into the methodology, from the real estate methodology?
So I guess to the extent that an ESG issue is material, it's always been factored into our assessment of ratings. We do have a ESG criteria that we published, I believe it was earlier this year or late last year, to be sort of more transparent with respect to how we assess ESG issues. And then, like I mentioned earlier, there are a few specific areas in our sort of key BRAs where we do explicitly look to some ESG considerations as well.
Great, thank you. We have another question that is asking about COVID-19 and the impact on industrial real estate. Can we make the assumption that it was actually positive for this sector?
I hate to say that there's anything positive coming out of the global pandemic, but I think maybe one way to put that is that perhaps it accelerated, and I think we've heard this a lot over the last years, that the pandemic accelerated a lot of pre-existing trends. So to the extent that e-commerce penetration was increasing prior to the pandemic, I think that was no doubt accelerated through COVID, and it did, I guess it did help support sort of that underlying demand for industrial assets, both from end users, tenants, as well as investors. And it's created a very highly competitive environment, again, for both tenants and investors to be able to acquire sort of those modern distribution type assets.
Great, thank you. I apologize, we are short on time. We still have other questions, but we will definitely get to them. If we haven't responded to your question, we'll send you an email to get an answer for you. This concludes our Q&A period. Thank you, Chris. Thank you, Anthony. And thank you all for those that submitted questions. Really appreciate it. My takeaway from the webinar is that industrial real estate growth is here to stay due to long-term fundamentals. I hope that you found this webinar informative. If you'd like more information on the DBRS Morningstar's view on the industrial asset class, please see a commentary entitled Corporate Real Estate Spotlight, Industrial Renaissance, which was published on September 15th, 2021. so just about 2 weeks ago. Note that this webinar will be available online for replay in a few days. If you have any further questions for our presenters today, Chris Tsichlas or Anthony Bogdan, or the rest of the Global Real Estate Analytical Team, which consists of Chris Wimmer, Ernie Chu, and myself, please feel free to reach out directly to us. Thank you for taking the time to join us today, and have a great day.
Thanks, everyone.
Thank you.